Hey, what's up everyone? Welcome back to the channel. First of all, I'd like to apologize. It's taken me so long to make this video. I know since my last video, you guys must have been itching for the next one. The truth is, didn't really want to make this because in our last video, we talked about depreciation, where we actually learn how to save money on our taxes. Today, we're going to be talking about depreciation recapture, which is the opposite of that. Before we begin though, I wanted to clarify something from my last video. If you haven't seen it, I'll link it in the description below. You should watch it before watching this video so you can kind of understand the concept. The thing I wanted to clarify was that I didn't talk about passive and active income. For those of you who claim depreciation as a passive expense and you have a W-2, that passive expense will not work against your W-2 income. It'll only affect your rental income. I will try to make another short video describing the differences between passive and active income and how some of you may be able to move your rental income from passive to active. Now, back to depreciation recapture. It's an expense that is paid after you sell a property. So the depreciation recapture tax that you're going to be paying is the difference between your current basis in the property and your purchase price. So I wanted to give you guys an example. Let's say you buy a property for $275,000. This becomes the basis for your property when you purchase it. Now let's say you hold the property for 10 years and you were able to collect 10 years worth of depreciation. This would come out to be $10,000 per year. You will have collected $100,000 of depreciation expense over the span of that 10 years. When you do this, it lowers your basis in the property. So now on the books, you own a property that's worth only $175,000 after 10 years, even though you paid $275,000. So let's say you go to sell the property. What do we know about real estate? That real estate typically appreciates in value. Let's say the property you own is actually worth $375,000 in the market today. Let's say you list it, it gets sold for your asking price. Your basis is $175,000. So the $175,000 of the $375,000 you collect from the sale of your property won't get taxed. Now, depreciation recapture is your purchase price minus your current basis, which is $275,000 minus $175,000, which comes out to $100,000. So this $100,000 will get taxed at your ordinary income rate with a cap of 25%. If you are in a bracket higher than 25%, let's say 32%, you would end up saving about $7,000 from just the tax percentage. 25% of $100,000 is $25,000 at the end of 10 years. If you hadn't collected that depreciation over that 10 years, on $100,000, you would have paid $3,200 per year. Now, your other $100,000, which is calculated as capital gains, it's the difference between your purchase price and your sale price. So since you bought it for $275,000 and you're now selling it for $375,000, you're paying capital gains on the $100,000 that you're making. But I don't want to get into capital gains just yet. There's a little bit more detail that I want to put into this topic, so I will try to post everything about capital gains in the next video. Back to depreciation recapture. Even though you end up paying out $25,000 in taxes on the sale of your property, you have to understand you're still saving a significant amount of money. Two things happen. You have deferred those taxes over 10 years, which really helps building your financial strength over a long period of time. You are able to reinvest the money you save every year that can actually help you lead to more tax write-offs and generate you more income. You may also have the opportunity to pay off some debt, increase your cash flows that way. The other thing you need to consider is the time value of money. Now that $25,000 you pay is at the end of 10 years. Maybe that amount of money might have only been worth $20,000 at the end of 10 years. And that's typically due to inflation. I know talking about taxes and paying them is not fun. Understanding some of these concepts is very important to really the health of your investment. So in the next video, I plan on explaining capital gains a little bit more. It's not a hard concept, should be pretty easy. Now, I'm not an accountant and I'm not a CPA, so everything I tell you, you should always verify with your accountant and make sure that it fits in your tax planning. So, thank you for tuning in. I really hope you guys enjoyed the video and were able to get something out of it. If there are any questions or topics you guys want me to talk about, please let me know in the comments below. I'll try to make a video on that and explain it the best way I can through my experiences. And I hate to ask you guys to do this, but if you guys can like and subscribe, I'd really appreciate it. Thank you for joining, and I'll see you guys on the next one.